Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Cisco.
If you find our talks useful, please consider subscribe, like, and comment underneath. All right, so let's be real for a minute. When I hear Cisco, my brain immediately travels back in time. I'm thinking, 1999. I'm thinking dusty server closets, endless tangles of blue Ethernet cables.
Beige boxes, right?
Exactly. The beige box is sitting in the corner that nobody touches until the internet goes down.
Yep.
It just feels like the definition of legacy tech.
Yeah.
Boring plumbing.
Yeah.
But you're suggesting that reputation is, what, wrong?
It's not necessarily wrong, but I would say it is dangerously outdated.
Okay.
If you are still looking at Cisco as just the company that sells routers, to keep your email online, you are missing one of the most significant under-the-radar shifts happening right now.
Under the radar feels like a bold claim for a company with a market cap this size.
But it fits. Everyone is looking at the flashy AI names, right? The chip designers, the startups. Meanwhile, the data we just got from Cisco's Q2 fiscal year 2026 report tells a story of a massive pivot.
Now, pivot to what?
They aren't just maintaining the internet anymore. They are actively building the physical backbone for the entire AI boom.
Building the backbone sounds great on a slide deck, but usually these legacy ships turn incredibly slowly. Does the actual hard data back that up?
The numbers are surprisingly agile for a giant. Let's just look at the headline figures from the report. Revenue came in at $15.3 billion.
Okay.
That is up 10% year over year.
10%. For a mature hardware company, usually you'd see maybe 2-3% growth, and Wall Street would call it a win. 10% is actually moving the needle.
It absolutely is. And if you peel back the layers to see where that money is coming from, it gets even more interesting.
Go on.
Networking revenue specifically, that's their core business, the hardware switching and routing. It surged 21%.
21. Wow.
And their non-GAAP earnings per share rose to $1.04, which is an 11% increase.
Hold on. Networking is up 21%. That's massive.
Mm-hmm.
Is that just inflation, or is that every office manager in the world deciding to upgrade their Wi-Fi at the same time? Because that kind of spike usually suggests it's a one-time thing.
It's definitely not just standard Office upgrades, though that plays a small part. No, this is the AI catalyst finally showing up in the balance sheet.
Ah.
This is the context you need for the wealth building angle here. It's about following the capital expenditure of the biggest companies in the world.
You mean the hyperscalers?
The hyperscalers. Amazon, Microsoft, Google, the entities building these massive data centers. Cisco's AI orders from them reached $2.1 billion.
In a year.
In the second quarter alone.
Just in Q2.
Oh.
Okay, $2.1 billion in 3 months just for AI gear. That puts the legacy argument to bed pretty quickly.
It does, and it's accelerating. Management actually raised their full-year FY 2026 AI order forecast.
No, they did.
Yeah, they were guiding for over $4 billion, and now they've explicitly bumped that up to $5 billion. They're seeing demand ramp up faster than even they expected.
That is a significant jump, but I have to play the skeptic here. When we talk AI hardware, the conversation usually starts and ends with NVIDIA.
Of course.
NVIDIA is the king of the data center. If they own the chips, why does Cisco matter? Aren't they just, providing the cables?
That is the multi-billion-dollar question.
Yeah.
And the answer is a little technical, but it's crucial for investors to understand. It's about the difference between a single computer and a supercomputer.
Right.
NVIDIA makes the brains, the GPUs. But to train these massive AI models, you need thousands of those GPUs all working together as if they are one giant brain.
The cluster, yeah.
The cluster. And those GPUs need to talk to each other constantly, sharing huge amounts of data with zero delay. If the network is slow, those expensive GPUs just sit there idle. That's wasted money.
So for a long time, the standard for connecting those has been InfiniBand.
Correct. Which is proprietary and, mostly controlled by NVIDIA. InfiniBand is amazing because it's lossless. It doesn't drop data packets.
But it's a walled garden.
Exactly. It's expensive, it's hard to manage, and that's where Cisco comes in. They are betting everything on Ethernet.
Good old Ethernet, the same stuff I plug into my laptop.
Essentially, yes, but on steroids. Ethernet is cheap, it's everywhere, and every IT engineer knows how to use it. The problem was, historically, Ethernet was lossy. Under a heavy load, it would drop packets, which is a disaster for AI training.
So Cisco's bet is that they can fix Ethernet.
Not just fix it, perfect it. This is where Silicon One comes in. That's their unified silicon architecture. They've launched the G300 chip, which is targeting data centers.
Yeah, what does that do?
It allows for high-speed 800G plus Ethernet switching that basically mimics the performance of InfiniBand, but with the cost and compatibility of Ethernet.
So they're trying to democratize the supercomputer network.
Sure.
Instead of buying a proprietary Ferrari engine and the proprietary road to drive it on, you could buy the engine but drive it on a superhighway that connects to everything else.
That's a strong way to put it. And they aren't fighting NVIDIA, they are hugging them close. They have a partnership, an NVIDIA Spectrum X integration. Cisco is positioning itself as the necessary networking layer for the NVIDIA chips. They're saying, sure, buy your NVIDIA GPUs, but if you want to scale them without locked-in headaches, you use our stuff to connect them.
That's the classic pick and shovel play. You don't have to find the gold yourself. You sell the shovels to all the miners.
And the market for those switches is a $600 billion opportunity.
Okay, so the growth story is this battle between InfiniBand and Ethernet, and Cisco is making Ethernet AI ready. That makes sense. But let's shift to the business model itself.
Sure.
One reason people, myself included, have looked at Cisco in the past is for safety. It's a defensive stock. But if they're pivoting to these high-tech AI battles, does that safety profile change?
I'd argue the safety profile is actually getting better, precisely because the business model is changing.
How so?
10 years ago, Cisco was a box seller. You sell a router, you get paid once, and you don't see that customer again for 5 years until the box breaks. It's a lumpy, cyclical business.
Feast or famine.
Right. But look at the report now. Over 50% of their revenue is coming from software and services.
50%. That's a huge tipping point.
It is. And a massive driver of that is the Splunk integration. You remember they acquired Splunk for $28 billion.
I do. A lot of people thought they overpaid at the time.
Maybe. But look at what it does for them. Splunk provides observability.
That's a buzzword I hear constantly. What does it actually mean in practice?
Think of it like this. Cisco builds the pipes, the network. Splunk is like a system of smart cameras and sensors inside those pipes.
Okay.
It doesn't just move the data, it analyzes it in real time. It can predict security breaches before they happen or spot a bottleneck before the system crashes.
So it turns dumb plumbing into smart plumbing.
And more importantly for an investor, it makes their ecosystem incredibly sticky.
Hard to leave.
Very hard. If you're a company using Cisco hardware to move your data and Splunk software to secure and analyze that data, ripping that out is a nightmare. You aren't just replacing cables, you're replacing your entire security and analytics brain.
Which gives them pricing power and recurring revenue.
Predictable recurring revenue. And that's why the board felt comfortable raising the dividend to 42 cents per share. They have visibility into their future cash flows that they just didn't have a decade ago.
Speaking of visibility, I want to talk about the backlog. The report mentioned RPO.
Remaining performance obligations. Yep. It's basically revenue that is contractually locked in but hasn't been delivered yet.
And that number is?
Sitting at $11.8 billion, up 11%.
Almost $12 billion just waiting in the wings. That's a serious safety net.
It is. It implies that this demand isn't just a flash in the pan. Customers are signing the contracts.
Okay, you're painting a very rosy picture here. Double-digit growth, AI booming, sticky software revenue, a dividend hike.
Uh-huh.
I have to point out the reaction. I looked at the charts. When this report came out, the stock actually tumbled. The headlines weren't screaming victory. They were reporting a drop. If everything is so great, why did the market throw a tantrum?
It's the classic game of Wall Street expectations versus reality. And we do have to talk about the margins because there is some legitimate concern there.
What's squeezing them?
In a word, memory. The price of memory chips, which go into all these switches and routers, is skyrocketing. That squeezed Cisco's gross margin down 1.2 percentage points to 67.5%.
Now, 67.5 is still a high margin, but Wall Street hates margin compression. It signals that maybe they don't have the power to pass those costs on to the customer immediately.
That's right. But the bigger spook for the market was the inventory numbers. Cisco increased their purchase commitments by 73%.
Whoa! Wait, they committed to buying 73% more stuff than usual.
Mostly memory chips and other components, yeah.
That sounds incredibly risky. If this AI boom turns out to be a bubble and pops next year, Isn't Cisco stuck with billions of dollars of useless chips? I mean, that's the bear case, isn't it? That they are over-ordering into a hype cycle.
That is exactly the bear case, and you can see it in the cash flow. Operating cash flow dipped 19% because they are spending cash now to secure these parts. If demand evaporates, that's a massive liability.
So is it hubris or is it strategy?
I view it as a signal of extreme confidence. You don't commit to a 73% increase in supply unless you are absolutely certain the orders are coming. They know that $5 billion in AI demand is real. They are loading the gun because they know they're going to need to fire it.
So they are stocking the shelves because they expect a rush, not because they are hoarding.
That's how I read it. But you can absolutely understand why a conservative investor might see cash flow drop and inventory spike and get a little nervous.
And what about the legacy security business? I saw a note that security revenue actually dipped 4%.
It did. And that's messy, I'll admit. But you have to separate the old from the new. The legacy firewall boxes are declining, but Splunk, which is the future of their security offering, is growing.
So it's a transition period.
Exactly. They are shedding the old skin while growing the new one. It looks bad in the headline number, but the underlying trend is toward higher quality software revenue.
So we have a stock that pulled back on, let's call it meh, guidance, margin noise from component costs, and this massive bet on inventory. This brings us to the decision point. Is this a falling knife or is this a buying opportunity?
Let's look at the technicals and the sentiment. To me, this pullback looks a lot like healthy consolidation. You have to remember, the stock had already risen over 8% in the prior 3 months. It was outpacing a lot of its peers.
So it's due for a breather. It ran up into earnings. People took profits. Makes sense.
Exactly. It's taking a breath near key support levels. But the institutional flow, and specifically those purchase commitments, suggest the insiders are gearing up for serious growth.
If I'm looking at entering this, what am I watching for on the calendar? What's the next catalyst?
Well, the next financial checkpoint is Q3 earnings in late May of 2026. But between now and then, don't just watch the stock price, watch the product announcements.
Okay.
They are going to be revealing more expansions to the Silicon One line, and you need to keep an eye on what they call the campus refresh.
Campus refresh sounds like a college renovation project.
It's the industry term for big companies upgrading their entire office networks. I mean, think about it. Companies are forcing employees back to the office.
Right.
Those employees are now using video conferencing, AI tools, and cloud apps at their desks. The old office Wi-Fi from 2019 just can't handle that traffic.
Also, companies have to rip and replace.
They have to. And that cycle is just starting to heat up. So you have the AI data center boom on one side and the boring but necessary office upgrade cycle on the other. 2 engines firing at once.
All right, let's bring it home. I need the final verdict. We've got the AI pivot, the Splunk integration, the inventory bet. What is the smart wealth play here?
I'm giving Cisco a bullish score of 8 out of 10.
8 out of 10. That's high conviction for a legacy name.
It is. Here's the elevator pitch. Cisco is successfully executing a massive pivot. They are moving from a hardware box seller to a high-margin software and AI infrastructure company. They're capturing the AI wave via Silicon One and Ethernet, which means they don't have to win the chip war to profit from it.
And the risk management piece.
That $11.8 billion backlog is your safety net, and the dividend pays you to wait. So despite the short-term noise about memory costs squeezing margins, the multi-year growth signal is flashing green.
So what's the strategy for the listener here?
I see this as a value entry into the AI renaissance. You aren't paying the insane premiums you'd pay for a pure-play AI stock that might crash if it misses earnings by a penny. You're getting a reasonable valuation with a solid yield.
And the time horizon.
My target horizon is a hold into FY 2027. You want to give it time for that AI ramp to fully materialize on the balance sheet and for the Splunk integration to really smooth out.
I like that. It feels like the adult in the room of AI investing. You're not gambling on a startup. You're betting on the guy building the roads.
Precisely. Don't ignore the giants just because they've been around a while. Cisco's proving it can dance with the new kids on the block.
And before we go, here's a final thought to chew on. We talked about Ethernet versus InfiniBand. Right now, InfiniBand is the gold standard for those super high-end AI clusters. But the history of tech tells us that good enough and cheap usually beats perfect and expensive. If Cisco makes Ethernet fast enough with Silicon One, we could see a world where Ethernet eventually eats InfiniBand's lunch entirely. If that proprietary tech dies out, Cisco pretty much owns the data center.
That would be a massive coup.
It would. Something to watch as 2026 rolls on.
The standard wars are just beginning. It's going to be fun to watch.
Indeed it is. That's all for today. If you enjoyed this deep dive into the plumbing of the AI revolution, let us know in the comments. Thanks for tuning in to Smart Wealth with Joshua. We'll catch you in the next one.
Happy investing, everyone.